and start looking at the plumbing. Most people think the economy is a stock market graph. It is not. The economy is a collateral chain, and right now, the chain is snapping. You know the headline number. The United States government owes $38 trillion. You know the consequence. $970 billion in annual interest. But those are just large numbers. They do not tell you how the system breaks. They do not tell you who is holding the bag. To understand the end game, you have to understand the three specific mechanisms keeping the patient alive: the quarterly refunding announcement, the basis trade, and the reverse repo facility. These are not economic theories. These are the life support systems. And one by one, they are failing. Let us start with the Treasury Department. In 2024 and 2025, the Treasury faced a mathematical problem. The United States needed to borrow $2 trillion a year, but the market demand for long-term bonds had evaporated. The so-called bond vigilantes demanded higher yields: 5%, 6%, 7%. They required this premium to hold United States debt for 30 years. If yields hit 7%, the United States government becomes insolvent immediately. The interest payments would consume the entire tax revenue base, so the Treasury changed the mix. They stopped issuing as many long-term 30-year bonds and started flooding the market with short-term T-bills, 3-month bills, 6-month bills. Historically, T-bills should make up no more than 20% of total debt issuance. Today, we are pushing past that limit. We are ignoring the safety guardrails. Why? Because there is infinite demand for short-term cash equivalents, but zero demand for long-term United States promises. This is the QRA Pivot. It is a desperate short-term fix. It is the sovereign equivalent of paying your mortgage using a credit card teaser rate that resets every 90 days. The danger here is rollover risk. When you issue 30-year bonds, you lock in your rate for 3 decades. You are safe. When you issue 3-month bills, you have to refinance that debt 4 times a year. The United States government is now refinancing trillions of dollars every few months if one Treasury auction fails. Just one. The overnight rate spikes and the entire banking system faces a liquidity cardiac arrest. Who is buying all this debt? It is not China. China is selling. It is not the Federal Reserve. The Fed is theoretically shrinking its balance sheet. The buyer is a handful of hedge funds operating in the Cayman Islands, but they are not buying it because they trust the dollar. They are buying it to exploit a pricing error. This is called the basis trade. In 2025, the leverage ratio in the basis trade hit 50-1. That means for every $1 million of actual capital, they hold $50 million in Treasury exposure. This is the danger. These funds are now the primary liquidity providers for the United States government. The stability of the world's reserve currency depends on leveraged speculators gambling on fractions of a penny. What happens if volatility spikes? If the volatility of treasuries rises, the banks lending money to these hedge funds increase the margin requirement. If the margin moves from 1% to 2%, the hedge fund is effectively wiped out. They receive a margin call. To pay the margin call, they have to sell the bonds. Selling the bonds crashes the price. Crashing the price increases volatility. Increased volatility raises margin requirements again. This is the doom loop. In March 2020, this exact loop almost ended the financial system. The Federal Reserve stepped in with $4 trillion to stop it. Next time, the position is twice as big, and the Fed is fighting inflation. They cannot print $4 trillion without turning the dollar into a failed currency. For the last 2 years, liquidity appeared stable. Why? Because the system had a savings account, the Reverse Repo Facility. In 2023, the Reverse Repo Facility held $2.5 trillion. This was excess cash parked at the Federal Reserve by money market funds. As the government issued massive amounts of T-bills through the QRA Pivot, money flowed out of the Reverse Repo and into T-bills. This drained the facility. It went from $2.5 trillion down to nearly zero in early 2026. Here is the critical data point. The reverse repo was the buffer. When the Treasury borrowed money, it did not drain bank reserves. It drained the reverse repo. It was sterilized borrowing. It felt like free money to the system, but now the piggy bank is empty. Every dollar the government borrows from this point forward must come from bank reserves. When you drain bank reserves, you crash the banks. This is exactly what happened in September 2019. The repo rate spiked to 10% overnight because reserves got too low. We are back at that cliff edge, but this time the deficit is $2 trillion, not $1 trillion. The banking system is not healed. It is hiding. In March 2023, Silicon Valley Bank failed. The Federal Reserve created the Bank Term Funding Program to save them. They allowed banks to swap their underwater bonds for cash at face value. That program ended. But the rot remains. As of the third quarter of 2025, the United States banking system is sitting on approximately $600 billion in unrealized losses. These losses are not marked to market. They are hidden in held-to-maturity accounts. But here is the new threat. Commercial real estate. $1.5 trillion in commercial real estate loans are coming due. Office vacancies in major cities are sitting at 20 to 30%. The buildings are worth less than the loans. Who holds these loans? Small and mid-sized regional banks. The exact same banks that are losing reserves because the reverse repo is empty. It is a pincer movement. On one side, their assets in commercial real estate are collapsing in value. On the other side, their liquidity is being drained by the Treasury. This is not a question of if a bank fails. It is a mathematical certainty. And when the next bank fails, the FDIC sits with a deficit. The bail-in will not be funded by the insurance fund. It will be funded by the currency printer. Finally, we must look east. For 20 years, Japan kept interest rates at 0%. This created the carry trade. Investors borrowed yen for free, converted it to dollars, and bought United States Treasuries at 4 or 5%. It was free money. Japan was the anchor tenant of the United States bond market. That trade is dead. In late 2025, the Bank of Japan was forced to raise rates to defend the yen. The 20-year Japanese government bond yield hit 2.75%. Suddenly, the math breaks. It makes no sense for a Japanese pension fund to buy United States Treasuries. If they buy U.S. bonds, they have to pay to hedge the currency risk. After hedging costs, U.S. Treasuries yield negative returns for Japanese buyers. So they are selling. We are seeing a structural rotation. The largest foreign holder of U.S. debt is exiting the building just as the U.S. needs to issue record amounts of debt. Supply is at an all-time high. Demand is evaporating. The only bridge left is the leverage. So, what happens next? We are watching for a liquidity event. It will not start on the stock market news. It will start in the plumbing. First, the Secured Overnight Financing Rate, or SOFR, will spike unexpectedly. This means banks do not have cash to lend each other. Second, a failed auction. The Treasury will try to sell $60 billion in 5-year notes, and the tail, the difference between expected and actual yield, will be huge. Third, a hedge fund blow-up. A major multi-strategy fund will miss a margin call on the basis trade. When this happens, the Federal Reserve has two choices. Option A, do nothing. Allow the clearinghouses to liquidate the hedge funds. United States Treasury prices crash. Yields spike to 8%. The government cannot pay its bills. The banking system collapses. Option B, yield curve control. The Federal Reserve announces they will cap yields. They will buy every bond the market refuses to buy. Option B is the only political reality. But understand what Option B means. To peg yields at 4% when the market wants 8%, the Fed must print the difference. If the market sells $1 trillion in bonds, the Fed prints $1 trillion to buy them. This is the moment fiscal dominance becomes monetary debasement. This is not inflation. This is a currency reset. The dollar does not die in a whimpering decline. It dies in a spike of volatility followed by a flood of liquidity. How do you position for a plumbing failure? First, avoid counterparty risk. If your money is in a high-yield fintech savings account, you are an unsecured creditor in the shadow banking system. Move to systemically important banks or direct ownership of assets. Second, short duration. Do not hold long-term bonds. If rates spike to 8% in a liquidity crunch, a 30-year bond loses 40% of its value instantly. Stay in T-bills under 6 months. Third, hard assets. Gold and Bitcoin are the only assets that are not someone else's liability. In a collateral chain failure, you want assets that are at the bottom of the Exeter pyramid. Gold is trading at $4,300 because it smells the counterparty risk. It knows the collateral chain is weak. The $38 trillion debt is the gunpowder. The basis trade is the fuse. The reverse repo drain is the removal of the fire extinguisher. And the quarterly refunding announcement is the government throwing matches. We are not waiting for a recession. We are waiting for a margin call. Watch the repo rate. Watch the Japanese bond yield. Watch the tail on the 30-year auction. That is where the truth lives. Everything else is just noise.